Alright, welcome back to Archi Lens. Today we're gonna talk about where is the real risk is in today's market. Most of investors think Dubai real estate market becomes dangerous when prices fall. And this is wrong. Because the real danger begins when prices stop moving, but the supply keeps coming. Because this is exactly when weak positioning gets exposed. For the last few years, almost everything worked. Prices were rising, demand was strong, capital was flowing everywhere. And in expansion phase like that, even weak decisions can look smart. But today something structurally got changed in the market. Not a collapse, but a transition. Because in 2026, Dubai is no longer operating on a pure growth phase, and the market is entering what I call the maturity phase, or more specifically, the hyper supply phase. Now, at the first glance, the number still looks strong. In the first quarter of 2026 alone, the transaction value reached over 167 billion dirhams, which sounds bullish, but the real signal is no longer the volume. In fact, it's the behavior underneath the volume, because something very important has already started happening, which is buyer becomes very selective. Not fearful, but selective. And March of 2026 already showed signs of slowing down. And of course, the second quarter of 2026 will likely feel very different. Why? Because most of the Q1 numbers happened before the beginning of the regional tension. And once you go deeper into the market, you will start seeing it, divergence. Apartments become more volatile, shorter cycles, more internal competition, and more pricing pressure. While villas here are still holding stronger and driven by something simple, which is land scarcity, and of course real end-user demand. But the most interesting signal is happening at the top in the ultra-luxury, because this segment starts softening first, which is actually makes perfect sense, because since 2021, the ultra-luxury was operating above its natural growth rate. And what we're seeing right now is not collapsing. In fact, it's normalization. And this is not emotional, but it is mathematical. Because as prices rise aggressively, rental yields compresses. And once the yield falls close to global interest rate, the risk premium disappears, which means investors start asking, why take more risk for similar returns? Now let's talk about supply, because this is where most people misunderstand the market. Yes, Dubai has hundreds of thousands of units scheduled by 2028. But here is the thing, that majority of that pipeline has already sold. And when I say majority, I mean over 70% was already pre-sold. So the problem here is not unsold inventory, but the real risk is timing between completion and absorption. Because when handover happens, you don't suddenly get one landlord entering the market, but you will get thousands of landlords entering almost at the same time. And that by itself creates what I call the handover shock, which is simply multiple owners trying to rent or sell almost identical units at the same exact time. And that weakens the pricing power. Not because demand disappears, but because competition explodes internally. And this is where the market splits. High supply zones like, for example, JVC and Dubai Land faces internal pressure, while constrained locations like, for example, Dubai Hills, Palm Jumeirah, Emirates Hills, the IFC and others, they return stronger pricing power, simply because the scarcity still matters. Now, for example, look at the pricing behavior. Yes, the growth is still positive, but momentum is slowing down. And again, this is not about supply, but it's about relative return. Because once the net yields compresses toward 4 to 5%, while the global rates remains near those levels, the money and the capital simply start pausing. Not panicking, but pausing. And this distinction matters, because what we are seeing right now is not systematic weakness, but it is market filtration. So the market is no longer rewarding momentum. Instead, the market starts rewarding positioning. And at the same time, the system itself remains stable. Sovereign rating remains strong, and developers today are not over-leveraged like previous cycles. In fact, most major developers are sitting on strong cash positioning, secured backlogs, and healthy balance sheets. So structurally, the foundation is still intact. But here is the thing, the behavior changed completely. And right now, almost every asset in the market gets filtered through three questions. Is the demand real or speculative? Is the supply limited or repeatable? And if I need to exit, who exactly buy this from me? Because in maturity phase, weak liquidity gets exposed first, which is why capital today survive best in asset with real anchor demand, limited replication, and strong exit liquidity. That naturally shift attention towards, for example, high quality villas, plots, scarcity-driven communities, and structurally differentiated assets. And everything outside that framework becomes more vulnerable. Not immediately, but structurally. Because hypersupply phase do not destroy everything equally, but they expose weak position selectively. And this is why the next phase of Dubai real estate market will look very different from the last one. And yes, expansion phase reward participation, but maturity phase reward precision. Because the market becomes more selective, more strategic, and far less forgiving. And through Archi Lens, we don't chase the market. In fact, we decode the structure and position within it.